Good day and thank you for attending. ZIRP and NIRP. Low and negative interest rates. What they are, and where things are headed. Here is just a short summary of the lecture. First, background and setting the stage. Next, definitions and terms defined. Then, presentation of the topic. And finally, a question and answer session for those times when there is a live presentation of the material. Before we begin, I would like to talk about what I call the levels of presentation for PowerPoint or death by PowerPoint, in order worst to best. I am trying for the level of an intelligent conversation, where after listening to this presentation, one would be able to carry on in and understand the topic in a discussion with experts in the areas. For my source I will use open or public license materials. Some use will be covered under Fair Use Doctrine for copyrighted materials. The Internet and PowerPoint has made it easier to get materials and for people to do follow-up research to verify points in the presentation or for further discussion. This presentation is my first test of PowerPoint, a video with text-to-speech presentation from SlideTalk. Net. The software is Microsoft Office 2003 PowerPoint. Are we in a new age for interest rates? The old standard from the 1970s and earlier was the passbook savings account at 5.25%. Around the same time, people used to talk about the 363 Bankers Club, borrow at 3%, lend out at 6%, on the golf course by 3 p.m. In the late 1970s, interest rates were as high as 21% for money market accounts. While this was great for money market funds, and did finally kill inflation, it was a disaster for the economy and President Carter's re-election campaign. In the summer of 1982 a great bull market started with the election of President Reagan and the reduction in interest rates. In the run-up to 2000 there was an internet bubble that peaked and then burst March 2001, followed by 9/11 terrorist attacks. In mid-2000s, the prime rate was at 5%. In 2008 and 2009 it looked like the world was coming to an end with the financial crisis, the failure of a number of banks, and the de facto nationalization of Freddie Mac and Fannie Mae, plus AIG was in trouble. TARP was enacted as a $700 billion bailout to stabilize the financial system, and over time rates were cut to zero, and in some places below zero afterwards. Now what happens? With rates at or below zero, where to go if no one wants to borrow at any price and you can't give money away? How do low interest rates cause asset bubbles? As an example of effect of different levels of interest rates, assume yearly cash flow is $10. What is the present value of the $10 for different interest rate? As one can see from the table, dropping the rate from 10% to 5% causes the present value to increase from 100 to 200, for a 100% increase. Going to 1% causes the present value to increase to 1,000, an increase of 900. The cutting of interest rates, especially when they are already low, causes dramatic increases in asset values. Why, usually, does it cost money to borrow money? Here are some of the 4 reasons that it costs money, interest, to borrow money. 1. Ancient, financing for herds or flocks. 2. Time value of money. 3. Risk of lending. 4. Supply and demand. In ancient times, it was financing for herds or flocks. In past times, people borrowed money to buy herds or flocks of animals. Over time any herd or flock would be expected to increase. The reason interest was charged on this money is because since the herd or flock was going to increase, the interest took account of this expected increase in the future. The time value of money. This is the cost of the borrower not having or being able to use the money while it is being lent out. That is why would I lend someone $100 with no interest when I could just not lend the money and have it available? The risk of lending. Interest is the compensation for the risk of not being paid back. Hopefully, The rate of interest on a pool of money is high enough to cover any losses plus provide a return. That is why would anyone lend money if they were going to lose money due to loans not being repaid? Supply and demand. The interest rate is the equilibrium between the supply of money available for lending, savings, and the demand from borrowers for that money. Normally, the rate of interest is positive, but in some extreme situations in the past, especially the financial crisis, the rate of interest may go negative. Examples are some Japanese bonds are bought with negative rates of interest because of deflation. Some short-term treasuries during the financial crisis had negative interest rates because people worried the bank was going to close, so demand exceeded the supply of treasuries, because treasuries were guaranteed by the U.S. government, resulting in a negative interest rate at times. Present value of a perpetuity and annuity. A perpetuity is a constant stream of identical cash flows with no end. Here is the formula what it means. If you were offered $10 per year forever or $100 now, both are equal and you would not care which you had. It also allows you to compare cash flows and/or asset values, since you can calculate the present value of each and then see which one is more valuable. An annuity is a stream of cash flows. This is the sum of a stream of cash flows discounted at the interest rate. Here is an example of $10 per year, for 3 years, with the interest rate at 10%. As you can see, the present value of those payments would be about $24.86. Negative interest rate. If interest rates are negative, why don't people just borrow $1 billion or even $1 trillion and keep the interest? Answer: because loans are usually backed by some kind of collateral as assets, and it is expected that eventually interest rates will go positive again, causing the value of the asset to fall, and requiring payments on the principal, making it impossible for the borrower to keep up with the payments. Q&A period. Thank you. lewisdeciger@gmail.com. www.the-competent-man.com- greater-than forum. Thank you for listening or attending today. I look forward to talking with you in the future, and online at the forum for the CompetentMan.com website.